Hey ladies.
Hey gentlemen.
My name is Stephanie.
My name is Joseph.
And we are from Permission to Be Wealthy. In today's video, we wanted to chat about our decision to sell our $550,000 home back in Texas, literally a year after we paid it off.
But if you're new to our channel is all about open and honest conversations couples should be having about money, building wealth, and giving themselves permission to be wealthy.
As we go through this video, I really want you all to consider the fact that in your personal finance journey, you are not 100% stuck with the decision that you make. This is a perfect example of something that Joseph and I were wholeheartedly gunning for. I mean, we were so excited that we paid this house off in 4 years after having a goal of trying to do it around 5, right? And then as we continue to educate ourselves about different options and what opportunities existed in the market to help grow our wealth, we really sat down and ran numbers to change that decision. And that's okay. And I think, you know, as you have a relationship with your personal finance journey, which should be for a really, really long time, there are going to be situations where you're going to change your mind.
Yeah, whenever she says a long time, she means a lifetime.
Yeah.
So your money should last you a lifetime. Well, as Stephanie talked about that, you know, I just want to reiterate what she was saying. You need to make sure that you give yourself not just permission to be wealthy, but permission to change the path of your wealth. Not making drastic decisions, but making decisions that are going to continue to improve your wealth over time, that are calculated decisions, right? And making sure that you're looking at all the data that you possibly can. And luckily for us, Stephanie is the person who does that. I'm the, again, if you've watched the videos, I'm the idea person. You give yourself the opportunity to have these deeper conversations so that you can change as you need to change. So what we'll do next is go ahead and dive into the numbers that Stephanie's kind of derived from running everything and what we're trying to accomplish, and why this big decision of selling which is now a $550,000 house. It wasn't that when we bought it. Now, a year after we purchased it.
Yeah. So as we go through this video, if you wait till the end, you'll really be able to get a sense of where we missed out on a $154,000 opportunity in gaining money.
That's a rental property.
Yeah,
somewhere.
in 2021. Bye-bye 2021. Hello 2022, guys. We're excited for the next year. And,
yeah, Happy New Year, by the way.
Yeah, Happy New Year. Feliz Año Nuevo.
Yeah.
But let's give you some context about this house, how we arrived to, you know, even living in it, renting it out, that whole bit, right? So we bought this house in 2017. It was our second home that we bought together. And in 2018, right after the new year, we were asked to move to Singapore to support an expat assignment that I came on for the company that I work for. And Joseph was all gung-ho and supportive about that. And we were really excited about the opportunity, but we literally only got to live into our house a little less than a year. And so we made the decision to go ahead and rent out that home. We had bought a home in a new area. So there was a lot of development in that area. We expected that it would appreciate in value. And we were thinking, what, Joseph, about 4%?
Yeah, roughly 3 to 4% is what we were anticipating based on what the market was doing. I think at some areas it was like 8%, which is not normal. We live in, the house is located near Austin, Texas, but we calculated roughly about 4%, yes.
Yeah, yeah. And this house is in Williamson County in Texas, which is north of Austin, north of Round Rock in the Georgetown area. It's actually one of the fastest growing counties in the United States, or at least it was at that time. And it's in a very high tax location. I'll let Joseph talk to you about that.
Yeah, so one of the catalysts behind this, as we started talking more and more, I'm a big fan of looking at where money is leaving our pockets, right? And you know, some of you will call that, you know, doing budgeting. I look at the bigger picture of this, not saying like I'm a big brain person, but just look at the bigger picture of where my money is going. And I'm going, every year we're giving away 3% of our earnings on that house to taxes alone. That doesn't include insurance. That doesn't include, you know, any maintenance on the house, on the property. And so you're looking at that math and you're doing the calculations. I don't know if Stephanie has those numbers in here if we're going to talk about those, but we're giving away a massive, basically what some people pay in rent every year, we're giving that away in taxes. So Stephanie, I don't know if you want to dive into that a little bit more.
Yeah, so on average, we pay a year in taxes on this home $11,000 to $12,000 a year.
Every time I hear that number.
Yeah, since we've owned the home, we've paid $49,000 in taxes, and that is 4.5, almost 5 years of owning the home now.
Yeah, that's a down payment on another house.
Yeah.
At the end of the day, right?
Yeah.
And that's you start doing that math, and then you start projecting what that is if it's invested into an index fund, which we enjoy investing into, we like investing into. And you start doing the projections on that, and it really makes you sick to your stomach thinking about giving that much money away just in taxes alone.
Yeah, yeah. So the other thing about this house is we bought it for $425,000. And of course, you all are very familiar with what's been happening in the market, specifically in 2020 and now in 2021. I think last year, the housing market grew on average 18.9%, which it broke a 45-year record in terms of, housing value. But this house is now valued around $550,000, and we're estimating that conservatively. We've got a number of different resources that tell us it's worth more, but we are conservative projectors and investors to an extent. So that's what we're banking on in terms of the value of the home. So the value of the home is appreciated about $125,000 in less than a 5-year span. It's eclipsing what we thought would be at the time. So do you want to talk a little bit, Joseph, about capital gains and what we're having to consider?
Yeah, so as we look at this property, of course, you're going to have things that help you depreciate or take some of that capital gains hit off, like paying our realtors, our realtors who do the leasing and things like that. But roughly, you're going to be looking at, I don't know the exact number on capital gains, I think it's 20%.
20%.
So we're going to be looking at paying 20% capital gains. Now, specifically, the reason we have to pay capital gains is because we haven't lived in the house for over 2 years I guess the best way that most people look at it is in a 5-year period, you have to live in the house for 2 years, and then you don't have to pay capital gains. You can keep all that money that you've gained and put it in something else if you want to. But if you've lived in the house for 2 of 5 years total, then you don't have to pay capital gains. We only lived in that house like
less than a year.
Like 8 months before we had to move. So we're going to have to pay capital gains.
Yeah, yeah.
And that's going to hurt quite a bit, actually.
Yeah. And it definitely wasn't anything we were expecting.
Yeah.
And quite frankly, we didn't buy this home with the intent of renting it.
Or selling it.
Right? So I heard somebody tell me a term, you become either renters out of intention or you become renters just because
different factors you can't control.
Yeah, different factors you can't control. And we became renters because of the latter. Obviously the tax situation with the house is a big factor in us selecting a rental property in the future. And there's a number of other ways that we would look at cash flow when it comes to renting a home in the future. This is not an ideal rental home for us.
Yeah, so as we dive a little bit deeper into this, one thing to consider is this was our primary residence. We planned on living in this home for many, many years. And the fact that it became a rental property and obviously allowed us to come here to Singapore, and some of you who have followed our story has put us in a really good financial position by having a rental property. And so if this rental property was actually maybe in another location that wasn't 3%, Stephanie, correct me if I'm wrong, let's say it was in a 1 to 2% tax location, saving us a little bit more money or helping us gain more money that we can allocate to other investments, we might consider keeping it. However, because of that massive $11,000 to $12,000 that we give away every year in property taxes, it doesn't make sense for us to keep this property as an investment property. So we may buy another property in the near future.
Yeah, I'll give you some perspective. We actually ran some numbers last year. So if we took the $550,000, let's say $525,000 because we'll have to pay capital gains at the end of this whole equation. But if we took that and if we split the money across 2 different rental properties, or just one, at $250,000 in an ideal location where you get the right value from a renting perspective, the right tax location, we would be making the same amount of income on that home as we're making on this $500,000 home. That was just a no-brainer to me, really.
Yeah, so basically we buy half the amount of house that we currently own and make the same amount of income.
Yeah.
Just because of the tax. Like the tax area. It doesn't make any sense.
Yeah. So to give you some sense of the cost of home ownership, these are the things that you have to consider. Taxes is a big one that we've discussed. HOA fees, we pay about $1,000 in HOA fees a year. Insurance for the home, so we pay about $900 in insurance a year. Any other maintenance, that type of thing. When you're paying an actual mortgage, you're obviously paying interest. So we paid interest on our home while we were paying our mortgage, any other kind of miscellaneous things. But I went ahead and I ran all the numbers associated to the expenses that we've paid on this home since we've owned it whether we paid the mortgage off or not. And we've paid $126,000 in overall expenses on the home. We've gained, including the appreciation of the house, $241,000, which is the $125,000 of the appreciation on the home, and then $116,000, which is the last 4 years worth of rental income. And if we take capital gains out of it, which is the $25K, we really only make, when we walk away and we sell the house, let's assume for $550,000, we only walk away with $90,000 in income.
Yeah, I mean, whenever somebody says that, $90,000 is still a lot of money. So let's be very clear on that. Not to, in 4 years, $90,000 on an investment is a 500. Well, actually, it was $425,000 investment at the time. Is a pretty good return, right? I think most people will take that. It's almost 20% return, right? Yeah. However, whenever you really break it all down, that same amount of money over the course of 4 years, if it were invested in the stock market, Stephanie, I don't know if you have those numbers or not. I think that's going to shock a lot of people. So you're saying we technically will walk away with roughly $90,000, and if we had that invested, the same amount of money invested at the time of whenever we purchased the house, roughly how much money would we have made?
Yeah, well, okay, so
I'll
actually break this down a different way.
Okay.
Because I didn't run the numbers from the time when we bought the house and what it would be, but I just put it in terms of, let's say next year, if the market performed a certain amount, what would we make on the house, right? Okay, so in the last 5 years, we've made the $90,000 and kind of take away on the home.
Yeah.
But if you took the $550,000 and invested that in the stock market, let's assume two scenarios. You got the first scenario that tracks the S&P 500, which last year performed at 28% return. So if we got 28% return on our $550,000, we would have made that $154,000 lost opportunity that I mentioned at the beginning of the video.
In 1 year.
In 1 year.
Versus 4.
In 1 year. Or if the market performed at about 10% rate of return, which is what the S&P 500 generally performs at, then we would have made about $55,000 in just 1 year off of that $550,000 investment. Now keep in mind, if we'd kept the home and we rented it and the house appreciated another 4% and we made the rental income that we're projecting to make in the next year if we continued renting it, the 4% gain would have been $22,000 and the rental income would have been $22,000. So net altogether, if we had kept the home, would have been $44,000 of gain. So you've got this 28% scenario in the S&P 500, $154,000 missed opportunity, or 10%, which is the average the S&P generates in gain, and that's $55,000. Or you keep renting the house, you have the house appreciate a little bit, you make some rental income, and oh, by the way, that doesn't account for any other expenses. It accounts for the taxes, but it doesn't account for any other expenses. So in our minds, it makes more sense to put this money in this capital in either the stock market or other alternative investments that could gain us a little bit more for our money.
So if I heard the math correctly, basically at the low end, we're still making $11,000 more by not having the property.
That's right.
With the potential of making an extra $110,000 or $104,000 more. Depending on what the stock market does. And again, we don't know what the stock market's going to do, right? We can give it a historical average and, about 8%, 10%. But it's still better than, one, worrying about renters. Not that we've had bad renters. We've had fantastic renters, by the way. Great people. Everybody that's come into our property has been fantastic.
Yeah.
But then you have miscellaneous things that we have to worry about. So the gain in the stock market and that pressure and worrying about that is a lot better for us than worrying about an asset that's in another, not just another state, another country that we have to worry about. And so if it was our primary residence, I don't even know if we would still have paid it off, right? I think we may have paid it off, but then question the decision now that we know more about our actual investing strategy, right?
Yeah. Yeah, it's an interesting question. I think, for us, paying off the home was a real psychological win.
Yeah.
That was at the beginning of our real, serious set some goals, achieve those goals, part of our financial journey, even though that was a year ago, right? But a lot can happen in a year, and a lot of amazing things and some, significant learnings have happened in the last year. And so I don't regret making the decision to pay off the home. And since we did that, we didn't have the $2,900 going to Wells Fargo for our mortgage, and the amount that we were also saving, because we kind of had this double savings plan, in place. So we were almost paying ourselves by not having this mortgage payment. We were paying ourselves twice and being able to invest twice. So this was a really critical element to us being able to invest $17,000 a month last year, which was mind-blowing that we weren't even able to do that.
To even think about that from a former school teacher, I think that almost made 2 to 3 months of that of investing that we do now was how much I used to make in a year as a school teacher.
Yeah.
So it's not like this just happened overnight, right?
Yeah.
So,
but let me say another thing too. Making money is one thing, but managing money is another, right? And so you hear all these stories about, these professional athletes or movie stars or, these crazy awesome entrepreneurs that have just amassed this ridiculous amount of wealth, and then 5-10 years later have literally nothing to show for it.
Yeah.
And I think part of that is you can amass it, but if you can't maintain it, if you're not smart about your money, if you're not, specific and goal oriented and like actually have a plan, automating, your money and where it's going, so you're not even seeing it and like psychologically thinking you can do something with it, is super important.
Yeah.
And so I firmly believe that our ability to save as much as we did last year was because we automated it and we didn't see it and we didn't touch it. And Joseph would shove it over to my side and say, like, go do whatever you're going to do with it. Here's our plan. Let's make sure we're sticking to it.
Yeah.
But I can genuinely say, and we'll do another video on this hopefully in the next couple of months, there are some things that I wish we did last year in terms of being able to still make some progress on some financial goals that we didn't get around to doing. Number one, because we just didn't start. And number two, because we didn't automate our way into doing it. And so that's going to be really critical into this next year of being able to hit some of those goals.
Yeah, I think one thing to take away as well whenever we get towards the end of this video, since we're getting there, is there are things that you're going to want to accomplish that you're not going to accomplish. But if they're part of your plan, you make sure that they're a priority so that you get to those things as quickly as you can, right? An example of that is, and we'll talk about this in our next video, so if you haven't subscribed, make sure you do. We're going to be talking about our crypto investments in the next video. That's something that we want to do on December 20th. We planned on doing. For Christmas, we're going to give basically one another, we'll call it $10,000 each, but $20,000 that we're going to, that's a nice Christmas present, $20,000 into cryptocurrency, right? And so we're going to be talking about that in our next video. That's something we want to do for Christmas, but we haven't done it yet because we didn't feel like it was the right time and we were knowledgeable enough to do that. And so be okay with not knowing everything and diving in and learning more, but still sticking to what your goal is. And so that amount of money is going to be roughly about 5% of our total net worth, but you want to make sure that you have that written down. It's a conversation that you're having with your spouse or your significant other, and then you go and have that conversation and you work the plan that you need to work.
Yeah. And don't be afraid of setting some crazy audacious goals. It was very scary to set a goal last year that said we were going to invest and save $200,000
and pay off our house.
Yeah, and we looked at each other and we're like, "Are we really going to do
Yeah,
this?"
is
We
that
almost
even
even
possible?
had some money aside to help us to the $200,000.
Yeah.
But once you get into the habit, if you do set those crazy audacious goals and then maybe some, icing on top, right? You'd be surprised at what you end up accomplishing, because once you get on this journey, it's addicting and it's very fulfilling and it's very rewarding because you feel this sense of accomplishment, ownership, freedom, peace, excitement about the future. You can obviously tell I'm very excited about what's gonna, come in the next few years, and even I think 10 years from now. How awesome could life potentially be, God willing? But yeah, don't be afraid to set hairy goals, even if you're just getting started. You will surprise yourself if you dedicate yourself to the craft.
So to end this video, I think the best thing to help people understand is that if your situation for your house may be quite different, very different, drastically different than ours, because that may be your primary dwelling. And you may feel more comfortable having that and having that peace of mind taken care of. So if you were to lose your job, at least you have your house covered, right? And so your goals may be quite different than ours. Or if you're somebody who has a house and you have an investment property, and that investment property, maybe that investment property actually covers your mortgage, right? And so you pay that one off. And I'm not telling anybody, this is not financial advice. We're not financial advisors. I'm just saying everybody's goals are different. Our goal just happened to be that we paid off the house. We realized that we could have made more money by not having the house paid off. And our investments are going to cover our living expenses wherever we move to next. So just know that your plan may be different than ours, and you should do your own research. But make sure you stick to whatever that plan is the best that you can, and it may deviate and change, just like where I was watching a video the other day, just like an airplane changes flight path, if you didn't know that. It's not just automated and it goes in the air and goes directly where it's going. It does change based on the air and the airstreams that it may follow. So be willing to change like an airplane in the sky.
It's a good one. It's a really good one.
Steph, you want to do the outro here? Again, stick with us, bear with us. We're trying to work on this new outro as we go through this. But thank you all for watching this video. Go ahead, Steph.
So if you like this video, give it a thumbs up, subscribe to our channel, and give yourself permission to be wealthy. See ya.